In this part of the lecture series on banking, we will delve into the intricacies of banking services, focusing on the professional aspects that are essential for those working within the financial sector. This section aims to provide a comprehensive understanding of the core services, their strategic importance, and the regulatory environment that governs them. History of banking services. The history of banking services is rich and varied, stretching from ancient civilizations to the sophisticated financial ecosystems of today. The evolution of banking has been driven by economic needs, technological advances, and regulatory changes, each shaping the services banks offer. Ancient origins. Banking activities can be traced back to ancient civilizations such as Babylon, where merchants made grain loans to farmers and traders. The Code of Hammurabi, one of the oldest deciphered writings of significant length in the world, includes laws governing banking operations. In ancient Greece and Rome, moneylenders exchanged currencies and offered loans, keeping detailed records of these transactions. Middle Ages. During the Middle Ages, banking took a more organized form in Europe. The Knights Templar provided one of the earliest forms of banking by safeguarding the valuables of pilgrims traveling to the Holy Land. Italian merchant banks from cities like Florence and Venice advanced the concept further, offering more complex services such as bill of exchange and government funding. The Medici Bank, established by the powerful Medici family, is a notable example of early banking prowess, helping to cement the role of banks in international trade and politics. Renaissance to Industrial Revolution. The Renaissance period saw the proliferation of banks throughout Europe. The establishment of the Banco di San Giorgio in Genoa in 1407, one of the oldest chartered banks, marked a significant development in banking history. As the Industrial Revolution took off in the 18th century, the need for capital increased. This period saw the rise of modern banks, with the Bank of England being established in 1694 to act as the government's banker. 19th and 20th century developments. The 19th and 20th centuries were a period of significant innovation and expansion in banking. The creation of central banks stabilized national economies, and commercial banks multiplied. The introduction of the Federal Reserve System in the United States in 1913 was a pivotal moment, designed to provide the country with a safer, more flexible, and more stable monetary and financial system. The 20th century also witnessed the birth of investment banking, with institutions like J.P. Morgan & Co. leading the way in corporate financing, underwriting of securities, and syndicated lending. The Great Depression led to further reforms, including the Glass-Steagall Act of 1933, which separated commercial and investment banking activities. Technological advances and modern banking. The latter half of the 20th century and the early 21st century have seen profound changes due to technology. The introduction of the computer and the internet transformed traditional banking practices, introducing online banking. This era also saw the rise of electronic trading platforms, ATMs, and credit card services, making banking more accessible to the general public. In recent years, the advent of fintech companies has introduced even more innovations, such as mobile banking, peer-to-peer payment platforms, and blockchain technology. These developments have challenged traditional banks to adapt and innovate continually. 1. Core banking services. A. Deposits. Banks offer various deposit products like savings accounts, checking accounts, and time deposits. Each type serves distinct purposes and offers different interest rates, withdrawal conditions, and benefits. For instance, time deposits may offer higher interest rates but restrict access to funds for a set period. B. Loans and advances. Loans are a primary source of revenue for banks. They can be categorized into personal loans, mortgage loans, and business loans. Each type has its own risk profile, interest rates, and collateral requirements. Understanding the nuances of each loan type is crucial for managing the bank's risk and profitability. C. Payment services. This includes the processing of transactions, fund transfers, and remittances. With the advent of digital banking, the efficiency and security of these services have become pivotal. The role of emerging technologies and regulatory frameworks in enhancing payment systems cannot be understated. 2. Investment Services A. Asset management banks often offer investment management services to both individual and corporate clients. This involves the strategic allocation of client funds into various investment vehicles such as stocks, bonds, and mutual funds to achieve specific financial goals. B. Wealth management. Tailored for high net worth individuals, wealth management services include not just investment advice, but also estate planning, tax consulting, and retirement planning. This holistic approach requires a deep understanding of the client's financial landscape and long-term objectives. C. Brokerage services. These services enable clients to buy and sell securities. Banks that offer brokerage services must navigate a complex system of regulatory requirements and ensure they provide transparent and fair services to their clients. 3. Risk management, EA. Credit risk. Understanding and managing the risk of losses from non-performing loans is critical. This includes the assessment of credit risk at the time of loan approval and ongoing monitoring of credit exposures. B. Market risk. This involves managing risks associated with changes in market prices, including interest rates, foreign exchange rates, and equity prices. Tools like value at risk, VAR, are commonly used to measure and manage these risks. C. Operational risk, including risks from system failures, fraud, and compliance breaches. Operational risk requires robust internal controls, regular audits, and a culture of risk awareness within the organization. 4. Regulatory environment A. Compliance banks are subject to stringent regulatory requirements to prevent fraud, money laundering, and terrorism financing. Professionals must be familiar with regulations such as Basel III, the Dodd-Frank Act, and the Sarbanes-Oxley Act. B. Consumer protection. Ensuring fair treatment of consumers and adherence to consumer protection laws is crucial for maintaining trust and integrity in the banking system. C. International standards. Banks operating globally must also navigate international regulations and standards, requiring a nuanced understanding of cross-border financial practices.